Microsoft stock is trading around $541, up 25% this year. And yet it's been underperforming most of the Magnificent Seven. So can this actually continue? Because Microsoft's biggest growth engine is now running into a huge bottleneck. Azure's revenue just hit $75 billion in 2025, up 34% year over year. That's massive. And now in Q1 2026, it's already up 40%. But there's a huge problem. Microsoft can't even meet demand right now. They've literally maxed out of data center capacity. Their CFO said it herself. The supply-demand balance won't normalize until December. That's 6 months later than planned. And that creates a rare setup where demand is surging, supply is tight, and the entire AI race depends on who can scale faster: Microsoft, Amazon, or Google. And here's where I think most investors are missing out on. Microsoft's early lead in AI cloud deployments: 62% of Gen AI projects all run on Azure. That lock-in effect could define the next decade of enterprise tech. But if they can't deliver capacity fast enough, someone else will. That's why in this breakdown, I'm going to show you the numbers that actually matter, what's really driving Azure's growth, and why Wall Street's $682 price target might be a little optimistic or maybe not even high enough. Hey, what's up? My name is Rick Orford. I've been trading since 1999, and no, I'm not a financial advisor. That's a good thing, because I break down the numbers so retail investors like us can make smarter, more confident decisions with our money. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. And you all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by almost 6 times. Go to fool.com/ricko to get your 10 stock picks right now. So with all that out of the way, let's get into it. Now, most of you already know Microsoft, but let me give you the full picture of what they actually do. The company is headquartered in Washington State, and they've been around since 1975. That's 50 years of operating in the tech industry, half a century of dominance, and that alone tells you how they've been able to survive every major tech revolution. Now, if you're new to investing, understanding what Microsoft does is pretty straightforward. They create software, devices, and cloud services that power businesses and everyday people all over the world. Now, you probably know Microsoft for their Windows operating system that runs on many computers, and for Office, which includes Word, Excel, and PowerPoint. But here's what's important to understand. Today, Microsoft makes most of its money from cloud computing. Their Azure cloud platform has become the backbone of Microsoft's business. And that's the real story: the shift from software licenses to cloud dominance. And Microsoft serves everyone. On one end, you have individual consumers using Outlook for email or Word to write documents. And on the other end, you have Fortune 500 companies running their business applications on Microsoft's cloud. And that's what makes Microsoft almost untouchable. They're embedded everywhere, from your laptop to the corporate servers. And over the years, the company has really evolved. They've gone from a software licensing business to a diversified technology leader. They're in cloud infrastructure, AI, gaming through Xbox, professional networking, and even enterprise software through Dynamics. And most of this has happened under their current CEO, Satya Nadella, who took over in 2014. He repositioned Microsoft as a leader in the ongoing AI era. And this is the key: their CEO didn't just pivot the company, he rewired its DNA for the future. And that's an important context, because the Microsoft of today is very different from the Microsoft of 10 or 15 years ago. And that transformation is why its growth story isn't done At least not yet, not even close. So let's take a look at Microsoft's stock price for a bigger picture. Right now, it's trading around $541, and the stock price has been in a general uptrend. Zooming out a little bit, Microsoft stock is up 28% year to date and 25% in the last 52 weeks. And compared to the rest of the Magnificent Seven, Microsoft has been trailing the majority for the last 6 months, performing just a little bit better than Amazon and Apple. In other words, the stock is strong, but it's not leading. And that is where opportunity sometimes might be hiding. Now, if you're bullish on Microsoft, and I know a lot of you are, you might see this as a great entry point. But like some investors in my Discord channel, I think you'd be likely interested to know what can drive the stock prices higher, because every bull run needs some fuel, and we need to find out where Microsoft is going to get it, right? The company's biggest catalyst. And to no one's surprise, it's its cloud business. Microsoft recently released its first quarter financials for the year, for fiscal year 2026, and Azure cloud service revenue, it rose 40% year over year. Now, if you remember, Azure alone generated over $75 billion in annual revenue in fiscal 2025, which is up 34% from the previous year. And companies use Azure to run their websites, store data, and increasingly to power AI applications. So yeah, being connected to AI growth is par for the course, but this kind of growth is revolutionary. I mean, Microsoft's cloud isn't just growing, it's swallowing market share faster than anyone ever expected. And something that's interesting is Microsoft also disclosed Azure's revenue as a standalone number for the first time ever. And when a company busts out the numbers for a standalone product, you know that management is feeling pretty confident about its position against competitors like Amazon Web Services and Google Cloud. Microsoft has also been aggressively building out infrastructure to support AI workloads. Over the last 12 months, the company added more than 2 gigawatts of data center capacity, and that's enough power to power about 1.5 million homes. That's not just expansion, that's a moonshot bet on future AI demand. The market share statistics are also very promising. Microsoft accounts for 45% of new cloud AI case studies and 62% of Gen AI focused projects. This just means that when businesses decide to deploy AI applications, they're more likely to choose Microsoft's platform than AWS or Google Cloud. And I think this early lead matters a lot, because once a company builds its AI infrastructure on a particular cloud platform, switching becomes difficult and very expensive. So once a company is in Microsoft's ecosystem, I think they're locked in for the long haul. However, even a company as big as Microsoft, they're not risk-free. So let's talk about the challenges that the company's facing. Now, the broader AI industry, they're facing operational challenges, particularly due to capacity constraints in data centers. There just isn't enough computing power, space, or energy supply to keep up with this soaring demand for AI training and workloads. Even their CFO said infrastructure shortages, they persist, and that the supply-demand balance isn't expected to normalize until at least next month. Now, previously, management indicated that this balance would be achieved by June. So that, at best, is a 6-month delay. And in tech, a 6-month delay might as well be a lifetime, right? And this is critical for a couple of reasons. First, it means that Microsoft is leaving revenue on the table because it can't meet current customer demand for Azure. Imagine, it's like customers want to buy your product and you don't have anything to deliver. That's money left on the table, and in this market, every quarter counts. Meanwhile, the competitors with available capacity, well, they could win those deals that Microsoft can't immediately fulfill. And if a business needs cloud infrastructure today and Microsoft says they need to wait several months for it, well, who do you think they're going to go to? They could choose AWS or even Google Cloud. Still, having clients line up for your services is a better problem than having no clients at all. It also means that once Microsoft brings additional capacity online, customers will be waiting to use it. So I think it's a temporary bottleneck, but it's testing investor patience. The question is, how many of those waiting clients switch over to a competitor? I mean, that's the problem. Demand is not the issue, fulfillment is. Now, as I said, Microsoft just released its first quarter financials for fiscal 2026, and I'm going to be covering that in depth in a future video. So be sure to look out for it because the numbers there, I think they might completely change how you see this stock. Now, with all that out of the way, is Microsoft stock a buy right now? Well, to answer that, let's see what Wall Street thinks. Right now, a consensus among 48 analysts rate Microsoft a strong buy with an average score of 4.81 and a high target price of $682. That's around a 26% upside from here. So the smart money is clearly betting that Microsoft isn't done running. But price targets, they don't always tell the whole story. But what do you think? Do you think Microsoft can outperform its competitors in 2026? Or do you think it's due for a correction? Let me know in the comments below. And while you're there, if you found this video helpful, don't forget to hit those like and subscribe buttons because it'll help others find the video, it'll support the channel, and you won't miss out on any of my future deep dives. Well, folks, that's it for me today in this video. I wanted to thank you so much for watching, and I'll see you next time.